the way forward? Let's understand that from Mr. Kaleeswaran Arunachalam, who is the Group CFO and Head of Strategy at Crompton Greaves Consumer Electricals, joining us on the show. A very good morning and thank you so much for your time. Firstly, let's talk about your earnings. This time around, the earnings don't look that exciting versus what the street was actually penciling in. But the key highlight is your margins. Your standalone EBITDA margins did improve 60 basis point YOY basis. Help us understand what were the key levers driving this margin expansion and what's the outlook going ahead? Are we in to see more improvement for FY26?
Sure. I think overall we are pleased to announce results where we have grown at 10% for the full year standalone. This is our second year of double-digit growth on the basis of Crompton 2.0 strategy that we launched about 2 years back. Some of the key pillars that we talked about then is turning around our lighting business, which is now back on track, including margin expansion. Butterfly business, we said in Q4 we should start seeing growth, and we are already seeing green shoots of that. We also wanted to talk about supply chain transformation, which can be a competitive advantage for us. We have announced a greenfield project, which will involve about 350 crores of capex, which is also going to come in from. Now, looking back at the year and the quarter went by, in spite of Q4 delivering a mid-single-digit growth, our margins continued to expand. This is on the back of few actions. One, consistent price increases that we have been taking constantly over the last year. Quarter after quarter, we have taken on an average of 1 to 1.5% price increase. Two, mix is moving favorable. Three, Unnati, which is our flagship cost reduction program. We have been working on it both on direct and indirect cost. Earlier, we used to focus a lot on indirect cost. Now we have started working on indirect cost also. That's also starting to show results. A combination of all these 3-4 things have ensured that the overall EBIT margin for the company has gone up. In fact, we have reached a 3-year high on our ECD EBIT margin, reaching about 16.7% as we speak for Q4.
Right. Mr. Kaleeswaran, you spoke about price hikes. Which categories have you undertaken price hikes in and to what extent?
See, fundamentally, this is consistently over last 6 to 8 quarters. We have been doing this in ceiling fans, where we had a BEE 1.0 energy transition, which led to significant amount of input cost increase. So that is something we have been judiciously passing on. Price increase has never been our first option. We always evaluated what kind of cost activities we can undertake to ensure that the burden is not passed on to consumer. After carefully evaluating all those things, wherever there was price increase required, we have done it bite-sized in ceiling fans. Last quarter, we took a small price increase in our non-ceiling TPW fans also. Other than that, in other categories, it has been marginal increase in mixer grinders. We've taken about a percentage price point increase in mixer grinders also in Q4. That's largely a price increase calendar that we are adhering to. Mix is also a big factor. In pumps, for example, we launched out a brand architecture, which helped us to premiumize the pumps portfolio on the residential surface side, which is also giving us better realization per pump, driven by better mix.
What's done well in this particular quarter is your subsidiary Butterfly, which has returned to profitability in the quarter gone by. How sustainable is this turnaround and what's the outlook going ahead?
See, Butterfly, I think we laid out a clear plan about a year back. We said H1 would be a decline in FY25, which was the past year, mainly on account of some of the channel actions that we have to take, price increases that we have to take, margin corrections that we have to do, meant that we have to bite the bullet and get those fundamentals in place. We were coming off from there, and Q4 onwards, we said we'll be back to growth. This is aided by a lot of actions that we have taken on go-to-market and category innovations that we have started working upon. On the cost side, we have also worked on optimization, including people and non-people related cost, which has helped us to get the profitability back on track. Outlook for Butterfly, in the near term in FY26, we expect the business to grow in double digit. and deliver an EBITDA margin of around 8.5%. In the medium term, which is next 2 to 5 years, we expect the business to grow in mid-teens and move the EBITDA margin close to double digit.
Right. What about the ECD segment? Because that's shown a 6% growth, but lighting revenue fell about 2%. What led to this decline? Is it structural or seasonal? And despite the drop in lighting revenue, your EBIT margins did see a jump of about 700 basis points. What explains that?
First and foremost, I'll start with your last part of the question, which is on the margin improvement. Over a period of time, we used to rely on LED bulbs. We used to call out clearly that the market has moved to LED panels, which is a ceiling light, where Crompton was behind in terms of our share of portfolio. Consistently, we have worked out over a period, and now our ceiling portfolio is robust and it has grown in double digit. And ceiling as a portfolio has got a higher margin compared to bulbs and battens. That's one reason for the margins to improve. Second is fit for purpose products is what we have worked on, which is to ensure that any kind of despecking that we need to do, which meets in consumer requirements, has been done. Third is we have also gone into other accessories or adjacencies within the lighting business, things like floodlights, etc., which was not part of the portfolio, has helped us not only improve revenue but also work on margin improvement. This is also on the back of investments that we have increased for lighting as a business. Some of the other factors to look at is if I look at FY25 as a whole, probably on a like-to-like basis, it's been an industry-leading growth in FY25. The category has seen significant price erosions in the last 2 years. In spite of that, on a full-year basis, our lighting business has grown, which we believe is at an industry-leading level. Now, within that, B2C has grown in high single digit, which shows that the changes that we have made to our portfolio, the mix that we are driving in is giving us the right results. B2G has been a little sluggish. This is more to do with the government orders that needs to come in, which we expect to kickstart all the infrastructure projects maybe from H1 of this year, and that should also catch up in FY26.
But tell us, how is the overall demand environment shaping up this summer? Has the unseasonal rain impacted your seasonal product sales like fans or air coolers?
See, India has been seeing a weather change. We have always experienced an early winter, a late summer, or an extended monsoon, so on and so forth. So from our perspective, while yes, there has been some unseasonal rains that has been impacting on demand, if I look at full year and if I look at from a long-term perspective, we expect these things to even out.
Right. You've also announced a greenfield facility with a phase 1 investment of 350 crore rupees. Tell me, what capacity and revenue potential do you see from this expansion?
We are a very strong balance sheet company. We are net cash positive. Just to talk about the cash flow generation, we acquired Butterfly about 3 years back for 2,000 crores, and in about 3 years, almost the entire debt has been paid off. So cash accruals are very high, and we'll be using the internal cash accruals for this. The spend might be spreading over to perspective that it's going to be one, improve our supply chain capability significantly. It will also help us in leveraging cost, and therefore it will be ROC accretive. Now, in terms of the demand situation, we expect our fans category to grow well. And as you would know, we are today the world's largest manufacturer of fan, and the scale at which we operate and even the way at which we grew last year, that means we are going to add 1 to 2 million fans every year. That is significantly higher, and it's probably as large as some of the entry-level players in the fan segment. So on that kind of a base, we are looking at making world's largest fans factory. We would still have a healthy mix of in-house and outsourcing. This is largely to one, cater to our future demand, which we expect to be robust in the next 5-year to 6-year period, and also to ensure that we have the control on the entire value chain of fans for both in-housing and outsourcing.
All right, Mr. Arunachalam, with this we let you go on that. Really appreciate you taking the time out and speaking with us, and all the best for your upcoming earnings.
If you like this video, then like, share and subscribe to ET Now.